Hey guys, welcome back to the channel. In the previous two episodes, we have discussed the most important continuation and reversal patterns, how to identify them, and how to trade them in a very detailed manner. When dealing with both continuation and reversal patterns, we have a clear idea, or maybe we have a directional bias towards where the breakout will happen. That is, in the case of continuation patterns, we will look to trade in the direction of the previous trend before consolidation. And for reversal patterns, we will look to initiate trades in the opposite direction of the prior market trend. But the third type of pattern that we are going to discuss doesn't have a directional bias associated with it when it comes to the breakout or the trade direction. Or in simple terms, the breakout of the pattern can be in either direction, and we cannot judge the direction of the breakout before it happens. This category of chart patterns is called as neutral chart patterns or bilateral chart patterns. Since we cannot be sure of a possible breakout direction, these patterns can be dangerous because of false breakouts. More often than not, you will find yourself entering a breakout above or below the pattern consolidation only to see yourself fall prey to a false breakout. I have already made videos on breakouts and false breakouts in my price action course. You can check those videos to know more. In this part, we are going to discuss 3 bilateral patterns, how they work, and how to take trades, including the entry, targets, and stop losses. Now, the 3 bilateral patterns under discussion are: number 1, the symmetrical triangles, followed by the symmetrical expanding triangles or broadening triangles, and finally channel patterns, that is rising channel and falling channel patterns. If this series of videos are helping you become better at trading, then please do like and share this video and support our efforts to build a healthy trading ecosystem. Now, the target likes for this video is 2000 likes, and if it does well, I will make yet another video on a few simple ways to identify chart patterns easily in the market. So make sure you like this video and watch it till the end to get maximum benefit. Also make sure to subscribe to the channel and enable the bell icon so that you will not miss out on any upcoming videos. So let us start our discussion with symmetrical triangles. We have talked about ascending and descending triangles. The ascending triangle indicates a weakening of sellers with a contraction in volatility from left to right of the pattern, while a descending triangle signals a weakening of buyers and a decline in volatility, which leads to a strong breakout. Now, the working of a symmetrical triangle chart pattern is quite similar to these two triangle patterns. The symmetrical triangle is also a volatility contraction pattern, but here we are not sure who is the weak player. A contraction in volatility means that the price volatility in the market is shrinking, and it is a strong signal that the market is likely to break out soon. Now, before we get into the breakout part, let's first learn how to identify a symmetrical triangle pattern in the charts. I hope you're familiar with the fact that for an ascending triangle, there is an ascending trend line support and a flat resistance line, while for a descending triangle, there is a descending trend line resistance and a flat support line. Now, when it comes to a symmetrical triangle, and as the name suggests, the sides of the triangle slope equally, which means the slope of the ascending trend line support and the descending trend line resistance happens to have the same slope. Now, it is within these trend lines that the actual consolidation of prices happens, and both of these trend lines meet at a common point called the apex. Now, the triangle should comprise of at least 2 lower highs and 2 higher lows each to be considered as a valid symmetrical triangle pattern. The pattern looks like a funnel with the price squeezing from left towards the right with a contraction in volatility, which is associated with weakening of candlesticks and price action. Now, what does the price action indicate? It simply means that neither the buyers nor the sellers are interested in buying or selling. This is evident from the lower highs forming the upper trendline resistance, showing a lack of buying pressure, while the higher lows into the lower trendline support signals a decline in selling pressure. As you can see, the pattern started with big swings, which got shorter and shorter as the pattern progressed. The beauty of volatility contraction is that price cannot be squeezed forever. At some point, it must break out, and when it happens, it offers tremendous returns. Now, I have seen many experts believe that if a stock is rallying before the formation of a symmetrical triangle, it will eventually break out to the upside. On the other hand, if a stock falls before a symmetrical triangle consolidation forms, it should continue its decline after the breakout. Now, both of these assumptions are not right. These triangles offers little or no indication regarding the direction in which the stock or the index will eventually break out. Keep in mind that there is a lack of volume and price movement which gives rise to a symmetrical triangle pattern. And as a result, it is impossible to assess the direction of the breakout. Another common mistake traders make is chasing the breakout of a symmetrical triangle pattern, only to get trapped in a false breakout. So how do we eliminate this mistake? A great trading tool that you can use for identifying breakouts is volume. Real breakouts usually occur with high trading volumes and high volatility, while fake breakouts are usually associated with low volumes and look more like a range than a breakout. Since the levels of the triangles are inclined, it sometimes brings the price outside the frame of the triangle. This usually gets traders tempted and they assume that there is a breakout on the chart. So always make sure to confirm the breakouts. Another important point that you can keep in mind is that the closer the price gets to the apex of the pattern and the tighter the price consolidation becomes, the greater the chances of a real breakout and the price will quickly move in favor of your trade. Moving on, we will now focus on how to trade this pattern. That is, how to time your entry, set your stop loss, and determine targets or exits. Let's start with the entry criteria first. Now, wherever this pattern forms, we have to consider two scenarios. First is a breakout above the descending trendline resistance, and the second scenario is a breakout below the ascending trendline support level. Let's say the price breaks the upper trendline resistance level. Then you have four possible long entries available. The first approach is very aggressive, and the idea is to go long as soon as the price breaks above the resistance trendline. And all you need to do is to place a limit buy order above the resistance level, and you will be immediately long when the price breaks out above the level. And if the breakout is real, this is one of the best prices to enter. But this method is very risky and there are high chances that it might be a false breakout. The second method is similar to the previous approach. The only difference is that you wait for the price to break and close above the descending trendline resistance. You can enter long above the breakout candle highs once the candle closes. This method reduces the likelihood of a false breakout, but if the price momentum is strong, then you will be probably entering at a much higher price. Now, if you have missed both these entries, then you can even enter the market as the price pulls back or retest the resistance line of the pattern. This method can help you enter a trade even if you miss the breakout move. In this method, we have to wait for the prices to form a primary pullback or even retest the resistance turn support level and then move in the direction of the breakout. So you can take a long position when the price begins to move higher. The retest entry offers a better price than waiting for the close of the breakout candle. Also keep in mind that pullbacks and retest are usually associated with smaller candles. But the issue with this approach is that the market may not always give a pullback or retest, especially if there is a strong momentum backing the price move. So I leave it up to you to decide the entry type that you like based on whether you are conservative or aggressive in your approach. Also make sure to validate the breakout with volumes and other indicators to see if there is actually an interest among the market participants to take the prices higher. The entry techniques for a breakdown below the ascending trendline support are also similar, but here our bias is bearish and we will look to enter a short position. So you can either choose to go short on the breakdown or you can wait for a primary pullback or retest back to the support turned resistance level and then go short when the price starts to decline lower. But make sure to validate the breakout first using volumes and other momentum indicators to save yourself from being trapped in a false breakout. Now, how to set a proper stop loss so that you don't get stopped out too early. Now, the concept is simple. Your stop loss must be at a location that, if reached, will invalidate your trading setup. This means that if the market hits the stop loss, you will automatically know that your analysis was wrong. So if we talk about the stop loss placement for a breakout above the resistance level, do you think setting your stop loss just below the resistance level is a good idea? Well, I don't think so, considering the chances of fake outs or even deep wicks. So where else should you place it? Think about it. Where is the ideal place to set your stop loss so that if the market reaches it, you know the breakout is invalidated? Now, since the pattern forms higher swing lows, and if the price moves below the recent swing low and forms a lower low, then we can be sure that our analysis was wrong. So it is exactly the place where you need to keep your stop loss, that is just below the recent swing low. You can give the price some breathing space by adding one ATR buffer below the recent swing low to compensate for the deep stop loss hunting wicks. Now the same idea applies to a breakdown below the ascending trendline support. You can place your stop loss just above the most recent swing high level formed, or you can give one ATR buffer above the swing high level to be extra safe. Now, where to exit your winning trades for maximum profits? You may already be familiar that there are two techniques that you can consider: the trailing stop loss method and the price projection method. Now, how to exit your trade at the price projection level? Now, price projection techniques helps to project where the price momentum will exhaust itself. So here's how it works for a symmetrical triangle pattern. All you have to do is to take the distance between the highest and lowest points of the symmetrical triangle, that is the widest distance of the pattern. Then depending on the breakout direction, copy and paste this distance or project this distance at the breakout point. For example, in case of a bullish breakout, project this distance to be above the resistance level from the breakout point, and for a bearish breakdown, project the same distance to be below the support level from the breakdown point. Now, this will give you the price projection or the expected target level. Now, the concept of trailing stop loss is that we have no idea how long the trend will last. So we will trail our stop loss to ride the trend as far as possible to lock in gains as the market moves in our favor. So how do you actually trail your stop loss? Well, you can use an indicator like a moving average. For example, you can trail your stop loss using a 20 period, 50 period or even 200 period moving average, depending upon whether you are considering a short term, medium term or long term position in the market. This means you will hold your position until the market breaks and closes above or below the moving average, depending on the direction of the breakout. A more robust technique is if you make a trailing stop loss and price projection combo. That is, you combine both these techniques. This means if the market moves in your favor, but it has not reached your price projection level, you can use the moving average to lock in your profits. So even if there is a sudden reversal, you still protect what you have and do not give everything back to the market. Moving on to the second category of neutral patterns. This particular pattern is known by different names, be it a symmetrical expanding triangle or a broadening triangle pattern or a broadening bottom or top pattern, etc. The pattern looks exactly like a mirror reflection of a symmetrical triangle pattern. Now, instead of the price squeezing from the left towards the right, it actually expands with each swing. This is one of the reasons why this pattern is tougher to trade than other chart patterns, as the lows and highs get taken out one by one. It is also called a megaphone pattern because of the expanding shape of the consolidation. Now, when it comes to the identification of this pattern, the pattern can be formed during an uptrend or a downtrend, and it is referred to as a broadening top when it is formed during an uptrend and a broadening bottom when it is formed during a downtrend. When the two trend lines connecting the widening highs and lows of the prices diverge from each other, it is an indicating of a broadening triangle pattern. It shows the nervousness and indecisiveness of traders. Even though the price action is evident after each price swing, there is no clear dominance by a single player. That is, the buyers and sellers are trying to force their dominance, but each attempt is countered, resulting in a state of indecision. Moreover, there should be at least two price swings along the sloping trend lines. That is, there should be at least two higher highs into the ascending trendline resistance and two lower highs into the descending trendline support to consider it as a valid pattern. Now, similar to a symmetrical triangle pattern, in the broadening triangle pattern too, the breakout determines the direction of future price movement. Please note that there are a few categories of broadening patterns, be it broadening wedges, broadening tops with a flat support line, or broadening bottoms with a flat resistance line. But I will not be discussing these patterns because most of these broadening price action patterns occur rarely in the market. So I will always urge you to follow 3 to 4 strong patterns rather than running after each and every pattern on the charts. The more focused you become, the better the results will be. Now let's talk about the trading criteria, and let's start with the entry techniques first. As I have just mentioned, the breakout determines the future price direction and dominance of a single player in the market. This pattern does not come with a directional bias. So we have to focus completely on the breakouts to determine our position. So it all comes down to identifying a real breakout. As discussed earlier, one of the factors that will help determine a proper breakout is the volume. So a higher than average volume can be a good indication of a probable breakout. Moreover, you can make use of momentum indicators like RSI, MACD, etc. to validate a breakout from a false breakout. So with that in mind, let's talk about all the possible entries when a breakout happens above the upper trendline resistance. You can take a long entry as soon as the price breaks above the resistance, as this will give you a good entry price. But the downside is that it could be a false breakout and you could get trapped. So a better alternative would be to wait for the breakout candle to close above the resistance trend line and then enter at the opening of the next candle or above the high of the breakout candle. Now the problem with this approach is that if the breakout is associated with a good momentum, then you will find yourself buying at a very higher price. In addition to these, you can take a long position after a price pullback or retest back to the ascending trend line. As you may all know, a pullback or a retest is usually associated with weak candles. So you can take a long trade when the price begins to move in the direction of the breakout once again. The advantage of these methods is that you could get into a trade even if you miss the breakout. But on the downside, a pullback or retest does not happen every time, particularly if there was a strong price momentum during the breakout. Now the same entry methods are applicable in case the price breaks down below the lower trendline support of the pattern. In that case, you can take a short entry on the breakdown or after the breakdown candle closes below the support level. You can also enter a trade after a pullback or retest to the lower trendline support. Now talking about stop losses, placing stop losses for this pattern is actually a hard task. If you were to go by the general idea of placing the stop loss, it can be set below the top resistance line or below the lower support line in case of a bullish breakout, and on the other hand, a stop loss could be placed above the lower support line or above the upper trendline resistance for a bearish breakdown. But think about it. One of the stop loss is too tight and any price swing with long wicks can take out your stop loss, while the other stop loss is too wide, which will give you a poor risk to reward. So what will we do? One way to counter this issue is to place your stop loss in the middle of the pattern, that is at the center of the widest point of the pattern. So if you are very aggressive with your stop loss, you could even place the stop loss with respect to the breakout candle, provided you give enough breathing room for the price action to happen. This can be achieved if you place your stop loss by adding some buffer with anywhere from 1 to 3 times the ATR value. Now finally, we will be talking about the targets. For this pattern, I won't be really interested in trailing my targets. I'm satisfied with the projected targets. So you can set 2 targets using the price projection method. The first target would be equal to the distance of the smallest swing between the top and bottom trend lines. This distance is further projected above or below the trend line depending on whether it was a breakout or a breakdown. The second target level will be equal to the distance of the widest swing between the trend lines, which is projected from the breakout point. Now let's move on to the final type of bilateral pattern, which are channel patterns, namely the rising and falling channels. The channel pattern is also known as the price channel. The formation of the pattern is quite interesting and it is related to market trends. You can learn all you need to know about market trends in my price action course. Now let's talk about the rising channel first. The rising channel is formed by 2 lines, a bottom trend line support and an upper trend channel line resistance. So clearly the price is in an uptrend, And as you may already know, during an uptrend, price forms higher swing highs and higher swing lows. And when we connect all the swing lows together using a line, we get the uptrend line, which will act as a support for the prices. And if we connect all the higher highs, it will give us the trend channel line, which will act as a resistance level for the future prices. Moreover, we need at least 2 price swings on each of these lines to consider it as a trend line, and to confirm it as a valid line, we need at least 3 swings on each of them. Now, another important thing to keep in mind is that the lines should be parallel to each other, or in simple terms, the slope of both the upper and lower lines should almost be equal. And if the slopes are different, we know what it means, right? It will be a different price action altogether, and it will form a rising wedge pattern. Let's now talk about the falling channel pattern. The existing trend is a downtrend with lower highs and higher lows. By connecting all the lower highs together, you will get a downtrend line, which will act as a resistance level for the future price movements. On the other hand, if you connect all the lower lows, you will get a trend channel line, which will function as a support level for prices. Also keep in mind that the slopes of both these lines should be almost equal, or in simple terms, the line should be parallel. Now let's talk about how to trade a rising channel pattern. So you can take 2 types of trades when it comes to rising channel patterns. You can either take breakout trades when the price breaks out of the channel, or else you can trade the impulse price swings in the direction of the existing trend from the trend line. When it comes to breakout trading, the rising channel pattern is a bilateral pattern, meaning that a breakout can happen in either direction. But what I have observed is that the slope of the channel to some extent gives us the information on whether it will be a breakout or a breakdown. Let me explain. A channel with a very high slope or a very steep price action will mostly break down below the support trend line, while a channel with a medium or lower slope will have equal chances of breaking out or breaking down. Anyway, this is just an observation, but we should enter a trade only after a breakout has happened. Let's say the price broke below the support trend line. Now, if you are very aggressive, you can take a short position as soon as the price breaks below the support trend line. But this is risky, as it could end up being a false breakout and you will get trapped. So it is always ideal to wait for the breakout candle to close below the trend line and then enter on the opening of the next candle or below the low of the breakout candle. Now the downside is that if the breakdown is strong, you will end up selling at a much lower price. So yet another method would be when the price pulls back or retests back to the trend line. So both the pullback and retest are associated with small bodied candles. So when the price starts to move lower after the pullback or retest, you can take a short entry. Sometimes there could even be a price build-up near the support trend line, which is a very good signal that the price would break down lower, and it provides a much better reward to risk because of a tighter stop loss. Now all these breakdown entry techniques are applicable even if the price manages to break out above the resistance trend line. In such a scenario, we will look for long trading opportunities either after the breakout and close above the resistance, or after a build up near the resistance trend channel line, or even after a pullback or retest back to the trend channel line after the breakout. Now one of the most important factors to check out is the volume. So if you want to know more about analyzing volumes, you can check it out in my free price action playlist. Anyway, there should be a higher than average volume during breakouts. You can even use momentum indicators like RSI to validate the breakout. Moving on, let's learn how to place your stop loss. We will discuss the stop loss for a breakdown below the support level. The stop loss of the channel pattern will depend upon the width of the channel. If the channel is too narrow, then we can think about placing the stop loss just above the upper trend channel line. But if the channel is too wide, then we need to think about a different stop loss, because if we place it above the trend channel line like before, the reward to risk ratio will be severely affected. So what can be done? For a breakdown entry, we can place the stop loss just above the midpoint of the channel from where the breakout happened. But if you have taken a short entry after a build up near the support trend line, then you can keep your stop loss just above the build up or consolidation. And finally, if you have taken a position after a pullback or retest, then you can set your stop loss above the highest wick of the pullback or retest candles with some buffer for price action. Now, in case of a breakout above the resistance trend line, similar stop loss conditions can be applied there also. But in this case, we will be placing the stop loss below the midpoint of the channel from the breakout point if you have taken a breakout entry. Or you can place the stop loss below the consolidation for a breakout after build-up entry, and finally you can set your stop loss with some buffer below the lowest wick of the pullback or retest candles for a pullback or retest entry. Now let's discuss the targets, and as always we can follow three methods: price projection, trailing stop loss, and a combination of both. For price projection, we follow a price exhaustion concept. For a channel pattern, we measure the distance between the upper and lower trend lines and project this distance above or below the line depending on the direction of the breakout. This will give you your projected price target. Now, one interesting observation of the rising channel pattern when the price breaks down below the support trend line is that all the previous swing levels will act as price action areas. So you will have to closely watch what type of price action is occurring and then decide whether to hold your trades for more profitability or just exit your positions. Now, the other method is to use a trailing stop loss using moving averages of different periods depending on the type of trading style that you follow. The central idea of this concept is that when a price breakout or breakdown forms a channel or simply a consolidation, there is a good chance that the trend will continue for a longer period, and you can benefit enormously if you trail your stop loss. You will exit the trade only when the price crosses the moving average. So for short-term trends, you can use 20-period moving average. For medium-term trends, you can use 50-period moving averages. And for longer-term trends, you can use 100 or 200 moving averages. But it is always a good practice if you use a combination of both price projection and trailing stop loss methods so that you will be able to lock into profits whatever the outcome is. Now let's look at the second method of trading a rising channel pattern. This idea is only valid if the channel formed is wide enough. That is, there should be enough points between the support and resistance line. The idea here is to trade the impulse move or simply to trade in the direction of the trend. All you have to do is to look for buying opportunities from the trend line support level to ride the impulse moves, because impulse moves are associated with stronger momentum candles and you will be trading along with the market price flow. You can also make use of bullish reversal candlesticks like bullish pin bars from the support level to take a long entry. You can place your stop loss below the support trend line with ample buffer or below the lowest wick of the rejection candle from the support level. Your target will obviously be the resistance trend channel line. You can also trade the correction move from the uptrend line, but I don't generally recommend doing so. Now let's briefly discuss the trading criteria for a falling channel pattern. Now, similar to a rising channel, you can take two types of trades when it comes to falling channel patterns. You can either take breakout trades when the price breaks out of the channel, or you can trade the impulse price swings in the direction of the existing downtrend from the trend line. When it comes to breakout trading, the falling channel line is a bilateral pattern, indicating that breakout can happen in either direction. But same as before, the slope of the channel to some extent gives us the information on whether it will be a breakout or a breakdown. So a falling channel with a very high negative slope or a very steep price action will most probably break out above the resistance trend line, while a channel with a medium or lower slope will have equal chances of breaking out or breaking down. Anyway, this is just an observation, but you should enter the trade only after the breakout has been confirmed. Let's say the price broke above the resistance trend line. Now, if you are a very aggressive trader, you can take a long position as soon as the price breaks above the resistance trend line. But this is a risky business as it could end up being a false breakout and you will be trapped. So it is always ideal to wait for the breakout candle to close above the trend line and then enter on the opening of the next candle or above the high of the breakout candle. The downside is that the breakout could be too strong and you will end up buying at a much higher price. So yet another method would be when the price pulls back or retests to the trend line. So when the price starts to move higher after the pullback or retest of the consolidation, you can take a long entry. Sometimes there could even be a price build-up near the resistance trend line, which is a very good signal that the price could break out higher, and it provides a much better reward to risk because of a tighter stop loss. All these breakout entry techniques are applicable even if the price manages to break below the support trend channel line. In such a scenario, we will look for short trading opportunities, either after the breakout and close below the support trend channel line, or after a build up near the support line, or even after a pullback or retest back to the trend channel line after the breakdown. Now, one of the most important factors to check out is the volume. You can validate a real breakout using higher than average volumes during the breakout, and you can even use momentum indicators like RSI, MACD, etc. to validate the breakout. Moving on, let's look at how to place your stop losses. So we will discuss the stop loss for a breakout above the resistance level. As mentioned earlier, the stop loss of the channel pattern will depend upon the width of the channel. If the channel is too narrow, we can think about placing the stop loss just below the lower trend channel line. But if the channel is too wide, then we need to think about a different stop loss, because if we place the stop loss below the trend channel line like before, the reward to risk will be poor. So for a breakout entry, you can place the stop loss just below the midpoint of the channel from where the breakout happened. But in case you have taken a long entry after a build up near the resistance trend line, then you can keep your stop loss just below the build up or consolidation. And finally, if you have taken a position after a pullback or retest, you can set your stop loss below the lowest wick of pullback or retest candles with some buffer for ample price movement. Now, in case of a breakout below the support trend channel line, similar stop loss conditions can be applied there also. But in this case, we will be placing the stop loss above the midpoint of the channel from the breakdown point if you have taken a short entry, or you can place the stop loss above the consolidation for a breakout after build-up entry. And finally, you can even set your stop loss with some buffer above the highest wick of pullback or retest candles for a pullback or retest entry. Now finally, let's discuss the targets. Setting the targets can be done the same way as with the rising channel pattern. It could be price projection, trailing stop loss, or a combination of both. So please do refer the previous session if you have any doubts. Now let's look at the second method of trading the falling channel pattern. As mentioned earlier, the idea is only valid if the channel formed is wide enough. There should be enough points available between the support and resistance trend lines. Now the idea here is to trade the impulse move, or simply to trade in the direction of the existing market trend. So all you have to do is to look for selling opportunities from the trendline resistance level to ride the impulse move, because the impulse moves are associated with stronger momentum candles and you will be trading along with the market price flow. You can also make use of bearish reversal candlesticks like bearish pin bars from the resistance line to take a short entry. You should place your stop loss above the resistance trend line with ample buffer, or above the highest wick of the rejection candle from the resistance line. Your target for this case will obviously be the support trend channel line. So you can also trade the correction move if you want from the lower trend channel line, but I generally don't recommend doing it. Now, there are a hell lot of other patterns that you can find in the markets, from rounding bottoms and tops or saucer patterns, followed by diamond tops and diamond bottoms, V tops, V bottoms, broadening wedges, island reversal patterns, etc. The patterns that I have discussed over the course of 3 videos are more than sufficient to trade profitably in the market if you follow them correctly. Now, it doesn't mean that all the trades will become profitable, but the probability of your trading success can be vastly improved. Moreover, the time frames that you select for trading these patterns also form an integral variable for the success of these patterns. And mostly the win rate of chart patterns tends to improve quite a lot if you trade them at higher time frames. So that is it for this video. And if you want a video on how to find these patterns in the chart, please drop a comment and let me know. And if you learned something new today, please do like the video, share it wherever possible so that it can help others too. And if you haven't subscribed to the channel yet, please make sure to do so, and also enable the bell icon so that you won't miss out on any upcoming videos. I will see you guys with another video. Till then, bye.